we don't forget. There we go. All right. Hello, everybody. Thank you for coming tonight to our first time homebuyer webinar. I'm joined today with Daniel, who is my partner at On the Block Realty, and Jacob from Outline Financial, and he's our mortgage broker. And we're here to go through the home buying process with you, highlight some of the key things that you need to know as part of the process. And at the end of the presentation, we will make sure to open it up to questions for you. If you have any throughout the presentation, you can feel free to add them into the chat, and we'll make sure to address them at the end. Or if you just want to unmute and ask the question at that time, you can do that as well. So we will get started, and this is being recorded, so we will make sure to send this out to you afterwards so you have a copy of it as well. So as I already said, we're here, we're your team to help you out. On the Block Realty is a real estate brokerage, and you have been invited probably by one of our agents that is eager to help you with the home buying process. So any real estate agent that you work with On the Block are here to guide you through that search process and help you with the negotiations as well, and get you through that the first time hurdles, which can seem scary at first, but that's what we're here for, is to really help you feel comfortable with the process. And then, of course, Jacob, your mortgage broker, is here to help you with a lot of the preliminary stages of the process through securing your financing and making sure that it fits with your own needs. And I'll pass it over to Daniel.
All right. Oh, am I muted? I don't remember if I muted myself. I'm not even looking. No, I didn't.
You're
Great.
good.
You can hear me. Fantastic. Still, it's 3 years post-COVID, and we still have the mute questions on these things. Well, thanks, Katie. Welcome again to everybody. Thanks for joining us on a cold and snowy Wednesday evening. Before we jump into things, I do want to take a quick look at the big picture. And buying a home, it involves a series of steps. And even though every situation is different, these are what we've broken down, sort of the 6 key stages that you're going to go through during the process. First off, it's very important that you need to know what you want and what you can afford. And that's what comes with setting your goals and your budget, which we're going to talk about. Securing financing, which means, like Katie said, and like Jacob's going to talk about, getting pre-approved for a mortgage so you know exactly what price range you're working with. The actual search for your home. So once your finances are in order, it's important that that's when you start looking for the house, and that's when the house hunt starts. So we're going to talk a bit about how to find the right home, what to look for, what you're going to be looking for, and what that process is. Once you find it, you're going to be making an offer. So when you find it, we're going to go over how to structure a strong offer, what goes into it, things like conditions and all of that. Closing the deal. So from home inspections to finalizing your mortgage, this is where everything comes together. And then finally, closing date, moving in the finish line. But before you actually pop that champagne, we're going to talk about a few of the key things that you're going to want to handle. So through the seminar, we're going to go step by step so you know exactly what to expect. Before we get too far ahead, let's start with the very first thing, which is, once again, defining your objectives and setting realistic expectations. It's important to be clear on what you're looking for and what makes sense for your situation. It's going to save you a ton of time. It's going to help you stay focused. And it's important that you're looking to find the right home, not just any home. It's not just about finding a place. And I know years ago, the challenge in itself was just actually getting a purchase done, because the market was so crazy that the moment something came on the market, people felt the need, they needed to put an offer in. Luckily, the market's not like that now, and that affords you the opportunity to do this, what I'm going to call the right way, which is actually going through these steps and taking the time to find the right home. And in order to do that, it's important to start with the basics. You need to figure out, what kind of home do you actually see yourself in? Are you looking for a condo, a townhouse, detached home, something like that? Are you looking for a backyard? Do you need to be close to work, transit, family, things like that? We're going to talk a bit about that as well. And when you take the time to define these things, it actually helps you narrow down your search and also avoid falling in love with a place that doesn't fit your needs to begin with. It's also important to outline your timeline, your urgency. Are you hoping to buy right away? Are you just starting to explore? Is your lease maybe coming to an end? Or is this a complete life change for you that, maybe like you're starting a family, you're relocating for work, things like that? the more we're able to understand your timeline, and you are, it makes it easier to put together a plan that works for you as you go through the search. There might be special circumstances. Everyone's situation is unique. So maybe your mortgage process will look a little bit different, as Jacob's going to talk about, given your employment situation. Maybe you're a first generation home buyer, or maybe you're buying with other people, family members, partners, things like that. And whenever there's any special or unique circumstances, it's always important to identify that early as well so that we can plan accordingly. Um, it is super important, more than ever, that you also understand the role of the realtor. It's not just our job, as some people might think, to open doors and show houses. That is one of the things that we're able to do for you, but we're really here to guide you, to advocate for you, and make sure that you're protected throughout the whole process, whether it's negotiating the best price, whether it's connecting you with great professionals like mortgage brokers, lawyers, people like that, or just really making sure that all the details are taken care of. It's our job and contractual obligation to do everything in your best interest. Finally, even though it's in the middle there, because this is my way of passing things off to Jacob, budget plays a huge role in all of this. And understanding what you're comfortable spending, you're not going to be able to know that unless you're working with a professional who's able to take a deep dive into your situation and help guide you on how the mortgage process works and help you understand what you're able to afford. So with that, I'm going to pass it over to Jacob to talk all about the importance of the mortgage process and the work that he does to help you out.
Fantastic. Thanks, Daniel. So there are a lot of things that we can cover here, and a lot of the work that I do happens in the pre-approval process because it's so important that we dot all of our I's and cross all of our T's and are as sure as possible that there's going to be no issues when it comes to funding the mortgage once you do have the offer accepted on the property and it comes towards the closing day. So my part is going to be kind of in this first half here because we'll talk a lot about what goes into the pre-approval. In my first consultations with my clients, I like to talk about my role in the process as well. So I'm a mortgage broker with Outline Financial, which is an independent brokerage. And what this means is that I don't work for one specific lender, but I have access to a very long list of lenders, including big banks, credit unions, and other mortgage companies as well. So essentially, my job is to match up your specific financial situation with the mortgage solution that works best for you, depending on your vision, your goals, your personal financial situation, making sure that the mortgage fits with your lifestyle perfectly. Again, like I said, I don't work for the lender, I work for you, and I represent your best interests and negotiate on your behalf to the lender as well. I also like to address up front that I don't charge any fees. A lot of my clients ask me that initially, but it's a mortgage broker. The lender pays my commission when I close the mortgage, so there's essentially no extra cost to you to use my services. And my goal is to be your personal mortgage advisor. I, want to be there for you, supporting you through the process as long as you have a mortgage. Hopefully it's not forever, but as long as you do, I am the person who's there supporting you through the renewal periods and making sure that your mortgage always fits with your lifestyle and your goals. Next slide. Thanks, Katie. So I like to call the three pillars of qualification the three major things that lenders look at when they're qualifying you for a mortgage. The first and most important one is income. So when it comes to your income and your employment situation, that is the biggest factor that lenders consider when they're qualifying you for a mortgage. Essentially, how much income you make directly reflects the mortgage amount that they're willing to lend. The second piece is your down payment. So how much you have saved up that you're looking to put in to the property as your down payment, and of course, accounting for closing costs as well. And then the third piece is your credit. So your credit score, your credit history is very important when the lender is determining your credit worthiness as a potential borrower and how much they're willing to lend you as well. So let's take a look at income. I'm going to ask a lot of questions about income in our first consultation because it's very important for me to understand exactly what your situation is. Your type of income is important. So whether you're a salaried employee, an hourly employee, if those hours are guaranteed or not guaranteed, full-time or part-time, if you're self-employed as well. I won't get into the details there, but essentially we need a longer history of more of stable income. If you're a self-employed individual, it's not the end of the world. And there's lots of programs out there for those who are self-employed. So we can definitely chat more about that. that. Your length of employment is important, of course. It's different whether you're salaried or self-employed, for example. How long you've had that employment makes a difference. And then your debt servicing, which is basically how much of your income is going towards your existing debts, which could include car payments, student loans, and that kind of thing. And then factoring that into how much of your income is going to be going towards your debts that you take on when you have a mortgage, which includes the mortgage payment itself, obviously, property taxes, maintenance fees if you're buying a condo, utilities, and that kind of thing. The second piece, as we discussed earlier, is down payment. The down payment is definitely the most paperwork intensive part of the process. Be prepared to come up with quite a bit as far as bank statements go. Most lenders need a 90-day history of any account that is holding funds that you're using towards your down payment. So these are savings accounts, checkings accounts, RRSPs, any of your investments. I put crypto there as well because I like to touch on that very quickly. Crypto is still a hot topic in the lending industry. A lot of lenders shy away from using crypto for down payment. So my recommendation is that if you do have any cryptocurrency that you're planning to use for down payment, the best strategy is to take it out of the crypto account and have it in a regular account for at least 90 days before you're going to purchase a property, as that will then be looked upon more favorably by the lender. But every day that goes by, they get a little bit more comfortable with it. The only exception to this rule is gifted down payment. So obviously, these days, a lot of people need help from mom and dad when it comes to their down payment. So if you have a family member that's gifting you part of your down payment or all of your down payment, we just need to see it deposited into your account, and then that family member, the gifter, will sign a gift letter saying that they are gifting you that money for the purpose of the purchase of a property. There are some things I want to touch on here regarding down payment minimum. So just recently, the Ministry of Finance changed the rules around what the maximum purchase price you can offer with a payment of less than 20%. It is now increased to 1.5 million, or to be technical about it, 1.499999 and 99 cents. The current rules are that you need 5% of the first $500,000 of your purchase price, and then 10% on every dollar above that. So a quick example for you is that a $700,000 purchase would require a $45,000 down payment, because that's 5% of the first 500,000, which is 25K, and then an additional 20,000, which is 10% of that 200,000 on top. So your minimum down payment would be 45,000 in that case. And you can follow this rule all the way up to 1.5 million. If you are purchasing over 1.5 million, oh, sorry, let me touch on this first. So essentially, when you're purchasing with less than 20%, no, you're right, Katie. Yeah, perfect. When you're purchasing with less than 20% down, you're subject to what's called mortgage default insurance, sometimes also referred to as CMHC insurance. Essentially, because you're putting less than 20% down, you are required to purchase an insurance policy to protect the lender in case you default on the payments. And you can see from this little chart here that the lower the down payment, the higher the insurance premium is. It's not something you really have to worry about or shop around for or anything like that, because we do all of these calculations in the background. The lender does the calculations in the background as well. And the insurance premium is added to the mortgage amount. So you're borrowing that amount and then essentially paying it off over the lifetime of the mortgage. So there's no additional cost to you on closing, except for the sales tax on the insurance premium, which is usually between $1,000 and $3,000. So we need to make sure you account for that in your closing costs. But the bulk of the insurance premium itself, which could be anywhere between $12,000 to $35,000, just depending on your purchase price, is added to the mortgage amount. And essentially you're borrowing it and, again, paying it off over the lifetime of the mortgage. And then when you are purchasing at 1.5 million or higher, your down payment requirement is 20% minimum, and there's no exceptions to that. Perfect. The last pillar of qualification, as we call it, is credit. So this is very important because your credit score and credit history demonstrates to the potential lender that you know how to handle your debt, which means you know how to make your payments on time. You don't use your credit irresponsibly, like maxing out your credit cards, missing payments, and that kind of thing. There are different types of credit. There's, people can have student loans, credit cards, lines of credit, car loans, and car leases. And all of these add to your credit profile. And as long as you use them responsibly and make your payments on time, this helps to thicken and mature your credit profile, which is definitely a very good thing when a lender is looking to qualify you for a mortgage. My tips about credit here are start early. I know there's some people that say, when you're young, you shouldn't take a credit card. And I think more generally, the rule should be if you're young, you shouldn't take a credit card and use it irresponsibly, because that can definitely be a negative consequence that can last quite a while. But starting early is important. So if you are offered a credit card, when you're in first year university or something like that, my recommendation is to take it as long as you're able to use it responsibly. And by responsibly, I mean don't go over 50% of the limit. So if you have a $2,000 limit, don't go over $1,000 on the balance and continue to pay it down every month. Use it regularly and use it responsibly. Pay on time, obviously making your payments on time, and diversify as well. So what I mean by that is use different types of credits, different types of credit facilities, which means installment loans and revolving loans. So an installment loan is like a car loan or a student loan where you're making one payment every month or every 2 weeks and you're slowly paying down the balance. And a revolving credit facility is like a credit card or personal line of credit where you can withdraw from it and pay it down kind of at your leisure. And as a general rule, a score of 680 is the benchmark. So if your credit score is higher than 680, so in the 700s or 800s, that's considered good to excellent credit, and you shouldn't have an issue getting qualified for a mortgage. If your score is under 680, you may have a little bit of trouble, and we can put a plan in place to remediate your credit score as well, just to make sure that you are in a position to make a purchase. Okay, so for the second part of my part of the presentation, I'll talk a little bit about the miscellaneous things that we talk about on our first consultation as well. I get a lot of questions, obviously, about first-time buyer programs. There are quite a few out there, but these are the three biggest ones that I like to touch on. The home buyer's plan, or the RRSP withdrawal, is very important. Essentially, as a first-time buyer in Canada, you can withdraw up to $60,000 from your RRSP, and that's per borrower. So if there's two people purchasing and you're both first-time buyers, you can each withdraw up to 60K, so up to 120,000 total for the couple from your RRSP towards the down payment. And the second one is the land transfer tax rebate. So within the city of Toronto, you have to pay two land transfer taxes. If you're outside of the city of Toronto, you only have to pay one. But the maximum you can get back if you're within the city of Toronto is $8,475. It's not so much a rebate as you just don't have to pay it. So your lawyer does the calculation and you don't have to actually pay the full land transfer tax. It's not a small amount. It's definitely something that everybody should be taking advantage of if you can. And your lawyer should ask you the questions about, are you a first-time buyer, and make sure that you do qualify so that that's factored in on closing. And then the last one is the FHSA, or the tax-free first home savings account. You can open one and contribute up to $8,000 a year for a total of $40,000 maximum. And again, withdraw that similar to the home buyer's plan RRSP withdrawal to put towards your down payment. And you do get a tax credit for that in the following tax cycle for that current tax year. I'll talk a little bit about co-signers and guarantors because, again, as I mentioned earlier, first-time buyers almost always need, I shouldn't say almost always, quite often need help from mom and dad. I would say probably 60 to 70% of the first-time buyers that I work with, and I work with quite a few first-time buyers, do have help from their parents in some way, whether it is gifted down payment or co-signing or both. The difference between a cosigner and a guarantor, some of the differences are negligible, but essentially a cosigner adds income to your file. So if you don't have enough income to qualify for the mortgage that you need, a cosigner will fill that gap for you. It's almost always an immediate family member, and they are on title and they are on the mortgage and they are an owner of that property. You can set up the ownership split with your lawyer on closing. So you could do a 50-50 ownership. You could do a 99% and 1% ownership. That's something to talk to your lawyer about as well. But the cosigner almost always has to be on title and on the mortgage, and their assets and liabilities will factor into the equation as well. So if they have their own mortgage payment, their own car payment, that will need to be considered. A guarantor is a little less involved. It's usually when the main borrower doesn't have good enough credit to qualify. A guarantor will come on and just add a little bit of extra credit worthiness to the file. In some cases, they can be left off of title and left off the mortgage, and their assets and liabilities don't factor in. I just wanted to kind of give a quick breakdown of what each are, but most first-time buyers, when they need help, need a cosigner. And I will talk quickly about the stress test. It's another one of those things where the calculation is done in the background, so no stress. You don't have to worry about it too much. But when we're qualifying you for a mortgage, we're always taking the stress test into account. Basically, what it means is that you're qualifying for a mortgage that is more expensive than the mortgage that you're actually getting. A quick example here, so a $500,000 mortgage, if your actual rate is 5%, that's your actual monthly payment, $2,908. but you're qualifying for a mortgage at 7%. Currently, the rules are you have to qualify for a mortgage that's 2% higher than the one you're actually getting. So the payment that they're qualifying you on is at 7% or 3502. That's not your actual payment. That's just how they're qualifying you for the mortgage. So essentially, they're making sure that should rates go up, which is not happening right now, thank goodness, but we did see a large rate cycle where rates came up quite significantly. If rates do come up, you can still afford that mortgage payment, at least if rates come up by 2%. That's the general rule. It actually has helped a lot of borrowers in the last little while who were qualified at the stress test in 2020 and 2021. And then we saw quite a drastic increase in rates. It hasn't been as detrimental as it could have been because those borrowers were actually qualified using this same stress test. So, again, this is just a little tidbit about what it is. Nothing to worry about because it's always done in the background during the calculations. And a little bit on pre-approvals. Obviously, as Daniel mentioned, getting pre-approved is one of the most important first steps that you can take. Essentially, it helps you lock in a rate for between 90 to 130 days, depending on the lender. We require a full application and credit check. I like to review all of your documents up front as well. And the lender then also reviews your credit and your income situation. The most important part of the pre-approval, in my opinion, even more important than holding that rate, is that my team and myself and the lender have looked at your application, looked through your credit and your documents. There's at least 3 sets of eyes on your application before you go and put in that offer. The peace of mind that that gives you is huge and brings so much value. You know, different banks and different brokerages do it differently, but I invest a lot of time in the pre-approval because it's so important that we have that airtight package once we are putting in the offer on the property. So that, you know, if it means anything, I think that's really the most important part of the pre-approval process. And closing costs. So we talk a little bit about closing costs as well. Basically, I recommend budgeting between 2 and 3% in closing costs. If you're a first-time buyer and you're getting that land transfer tax rebate, it usually works out to be a little bit lower because the land transfer rebate is quite significant, but always good to budget more and not need it than the other way around. Obviously, land transfer tax is usually the biggest piece of your closing costs. Legal fees as well. I recommend budgeting between $2,000 and $3,000 for a purchase. Every lawyer charges a little bit differently, so I recommend talking to your lawyer and getting quotes just to make sure that you know exactly what you'll be charged for the legal fees. The sales tax on the mortgage insurance premium, as I mentioned, it's usually between $1,000 and $3,000, depending on your purchase price. And then there's a less tangible closing costs, which I'm sure Katie and Daniel can speak more to, but moving expenses, furnishing expenses, and that kind of thing. Everybody's going to be a little bit different in the cost on that, but the biggest ones to consider are land transfer tax and legal fees. And I put together a couple tips and common mistakes. Knowing your budget, knowing your carrying costs is very important. Purchasing a home can be a very emotional process, and budgets can go out the window very quickly. So being firm in your budget and knowing what your carrying costs will be, and by that I mean knowing what your mortgage payment is going to be, the property taxes, your utilities, maintenance fees if you're buying a condo, just so once you do close and you are paying that first month, it doesn't come as too much of a shock to you, and that is something that you know that you can sustain for the period of time that you do own the property. Don't change your employment after being pre-approved. And if anything does change, please let your mortgage broker or lender know right away. The worst thing you can do is kind of shove it under the rug, and then it comes up last minute, and it can be very bad for the whole deal in general. So if anything changes during the pre-approval period regarding your financial situation, just be upfront about it so we can mitigate it as soon as possible. Don't make big purchases on credit before closing. So don't buy a $5,000 couch before closing. Don't go out and get a new car before closing. Any changes to your credit can be flagged by the lender and cause them to reevaluate the whole application. So just being fairly stable with your credit situation before the closing period. Just wait till you close on the mortgage, then go get the car, go, put a bunch of purchases on your credit for your furniture. Fantastic. But just do it after you close on the mortgage. And avoid moving large sums of money. Going back to what I said about the down payment, is very paperwork intensive. And if lenders do see large sums of money moving around, we always need to track where they came from. It just has to do with very strict anti-money laundering guidelines. Lenders will not mince words when it comes to tracking down sums of money and where they came from. So it makes everybody's job more difficult when that happens. So if there is money that needs to be moved around, just let me know. know beforehand or let your mortgage broker know, and try to avoid it if possible. And knowing your closing costs, I think I mentioned that earlier, or I mentioned carrying costs. Knowing your closing costs, your lawyer should be able to give you an estimate. Usually, I can give you an estimate within the first consultation as well about what your closing costs are going to be, just so you know what your total cash to close required is, your down payment, and your closing costs. So once the bill comes before closing, again, you're aware of roughly what that sum of money is going to look like. And I think that's it for me.
Great. Thanks, Jacob.
Thank you.
All right. So now we are going to get into the search process. So now that you are pre-approved, ready to go, you know what your budget is, we then get involved from the real estate standpoint and start talking about some of the fun things about your home search. And it starts with an understanding of what your must-haves are in a home as well as your nice-to-haves. And it's important to differentiate between those two because the fact of the matter is, it's very difficult to find everything 100% in terms of what you want with your must-have list and your nice-to-have list. There's got to be some things that you likely have to give a little bit on. So must-haves may be the number of bedrooms or the neighborhood or the type of home, if it's a detached or a semi-detached home. Those things might be the must-haves, whereas nice-to-haves may be, an extra bathroom or a finished basement, things that obviously would be nice to have, but you don't necessarily need in order to live in the home. So these are things that when we first have our consultation with you, we understand that and go through that list and have an honest conversation as well with you about what if that is realistic in line with your budget, or if we might have to make some adjustments based on where you're at financially and what you're looking for. Neighborhoods is a big one that I think is really important to understand because you can change pretty much anything about the inside of a house, but at the end of the day, you're never going to be able to change the neighborhood. So it's really important that you are comfortable with the neighborhood that you are looking to purchase within. Obviously, if you have kids, schools is going to be a big one, or even just, the community centers nearby, parks, things like that. If you commute and maybe you work downtown, but you want to live in, Mississauga or Vaughan or Richmond Hill or whatever, commute is going to be a big one. So how long is it going to take you to get to and from work every day? Because obviously that factors into your lifestyle. So neighborhoods is a big one, and that's where your realtor can come in and really guide you on what matches up with your needs and can suggest neighborhoods that could be a really good fit for you. And it's important not only to see homes within that neighborhood, but also to drive around the neighborhood, go into some restaurants and some stores and to the parks and just get a good feel for what the neighborhood's like. The other thing that we suggest doing is even when you are really serious about a potential home and making an offer, maybe knock on the neighbor's door. Your agent can definitely help you with that, but have a conversation and have an understanding with the neighbors about what the neighborhood's like. They're the best resource for you to really understand what to know about the neighborhood and anything that might be a red flag. Obviously, market trends are a big thing. The market has changed quite a bit over the last several years, and depending on the type of home that you are looking for, it can be very different. So, for example, right now, the condo market is quite slow. There's a lot of inventory. It's a great opportunity for buyers if they're financially ready to get into a condo purchase because there's a lot of negotiation power there. The freehold market is a little bit more active, I would say, but depending on the area that you're looking for, it could definitely depend. So we want to have a conversation about those market trends and what to expect when you're looking for a home. And again, the budget is a big one. We want to stay really realistic with what your budget is. And, we've worked with buyers in the past that are sending us properties that are listed 100,000 over their budget, hoping that maybe they could negotiate down to under their budget. And, maybe sometimes that is possible, but I'd say 99% of the time, that's probably not the best strategy you want to go with. You want to be seeing homes that are priced within your budget, and your real estate agent can definitely assist you with that because obviously Daniel's going to jump in on this a little bit later, but the way homes are priced obviously factors into that. And that's where your agent can really guide you with that aspect of things.
All right. Good segue. So you found the home you love. You're ready to make an offer. You want to make it yours. Now it's getting serious. I mean, it's been serious, but now it's like pen to paper time for you. And so, in order to do that, there's a whole world of things that you need to consider. And as much as we wish that buying a house was like buying milk at Walmart, it's not quite the same thing from a price perspective, from a way that you transact and everything that goes with that. So, let's talk about what the main components of an offer are going to be. Obviously, price is a big one, if not the biggest one. But it's not always just about offering the highest number necessarily. It's really about putting together a strong offer that's based upon, among other things, the market conditions that you're dealing with at a point in time. Um, and in addition to price, which we will talk about more, there are a bunch of other components that make up an offer. One of those could very well be conditions, and that those are the items that are going to protect you and identify areas that might qualify your offer before it goes firm. So these are things like a financing condition. If you do need to make sure that your financing will line up with the price that you're offering for a home. Maybe it's a home inspection, which all of these I'm going to say, or at least those two specifically, in most cases, we do recommend form part of an offer because they are there to protect you. And so much so that when a buyer typically says to us, I don't need that or I don't want that, there is even paperwork that could go with an offer where you acknowledge the fact that it might very well have been recommended that you include a condition if you and you've opted against it. Um, but a home inspection is there to protect you and to give you an opportunity to look a little bit deeper with a professional into what might be going on in the house that you're not able to see in what is typically maybe a half an hour, if you're lucky, maybe an hour of a walk through a home. You live somewhere now, and I'm sure in an hour you could walk around your own house and not identify all the things that maybe a professional would be able to identify in the walls, under the floors, things like that. There could be other conditions that go with an offer, things like the sale of your current home. There might be conditions tied to specific components of a property. Generally speaking, those first two, the financing and the home inspection, might be the two that you see and that sellers are most used to seeing. Um, they are there to protect you again, but in some situations, and really in every situation, a fewer conditions on an offer will make your offer more attractive to the seller. So you do need to identify weighing the conditions, the necessity of them, and how that might impact your offer. Especially in a situation where you might be competing, which I'll talk about in a second. Another component is the deposit, which plays a role. Now, that's a sign of good faith to the seller. It's typically submitted within 24 hours of an accepted offer. The amount can vary, but for perspective, it on average will run at around 5% of your purchase price. Now, it's important to distinguish between that and the down payment. It's not the same thing as a down payment. The deposit is cash on hand that you will need within 24 hours of the accepted offer. So you need to be aware of your own cash flow and situation when you're formulating the deposit and even starting to put in an offer on a property as well. Finally, the timing can be a huge component of an offer as well. How quickly can you close? Sellers often will have a preferred closing date. If they don't make it known, it is part of the job of your realtor to try to determine whether there is a preferred closing date. And if you can align with that, it might give you an advantage when you're making an offer. Now, your offer strategy is going to depend very heavily on the current market. If you're in a seller's market, for example, and historically we saw this again a few years back when there were so many people competing, more sellers than there were, or sorry, more buyers than there were sellers, which means more people are competing to buy a smaller inventory of homes. And when that happens, you get into situations you might have heard of bidding wars, where homes are listed with an offer date often. So they set a date where offers can be placed, and it's there to encourage multiple offers and people competing with one another at the same time. In a case like this, you often need to be prepared to potentially act fast, and you also need to typically come closer to putting your best foot forward right out of the gate and put together a truly competitive offer right away because you may not have another chance. It might not be a situation where you're in a back and forth negotiation because there's other people that you might be up against. On the other hand, in a buyer's market, when there's a lot more sellers and a lot less buyers, and you're not in as competitive a situation, you might typically have more room to negotiate, to take your time, to ask the questions, to put more conditions on an offer. It is more comfortable for a buyer to be in those situations, but it doesn't change the approach you need to take from market conditions and what a property is, worth, and in the valuation of a property, because you are still dealing with sellers who have an understanding of what the market is as well. So you need to be cognizant of the way you approach either situation. And it dictates how aggressive or strategic you're going to be able to be and that you need to be when you're putting together a competitive offer. And this is, again, why it's really important to work with the right realtor and the right professionals, mortgage brokers, lawyers, and all that to give you the advice to analyze the market, pull comparable sales, give you guidance on what's realistic, and help you understand really about everything that goes around the offer that you're making. How have similar homes sold in the area? What are pricing trends looking like? And how to structure your offer in a way that will likely maximize your chance of success. At the end of the day, if you're competing against other people, there will never be two identical offers. And it's not always the highest price that will get the home. So it's really important to go in there understanding the full story, asking the right questions, and again, really understanding where your own comfort level is. Because winning an offer and winning a property should not be the end game if that means it's pulling you outside of your comfort zone or it's pulling you beyond the budget you set for yourself. And these are all the questions you need to keep asking yourselves as you're looking, as you're starting to establish, like Katie was saying, the needs, the wants, when you establish your budget with someone like Jacob. When you put that all together, it paints a picture that when you get out there and start searching, you get a bit of a more realistic view of what it is that will work for you. And the quicker you're able to put all those together, the easier it is to approach an offer with the right mindset into things. Finally, understand that it's often that there's two ways you can look at it. You can come into the first place you see you fall in love with, and some people are reluctant to put an offer on the first place they see because they fall in love with it, but it's the first place they saw. Could be the right strategy. If you're not comfortable, don't do it. But always be aware that the market changes around you. And when you see something that feels perfect, if you don't go for it, that will become the benchmark against which future places you're looking at are going to be held. The same way that you shouldn't jump into something if you're not comfortable. You should feel like you have the opportunity to look at many places. And also, the first place you jump at, you might not get, right? So making an aggressive offer and doing all the right things is not necessarily a guarantee you're going to purchase the place because there could be 1, 5, or 10 other people with the exact same mindset that you have. And in some cases, people who just go beyond what reality states for the market. And such is life, but you need to be prepared for all the different scenarios. And again, communicating with the professionals around you is the most helpful way to do that. And so once the offer is in, the real fun begins, negotiations, counter offers, and hopefully an accepted deal. And then you move into the final stage, which Katie's going to talk about, which is closing the deal and all the fun stuff that goes with that.
Great. Thank you. So when it comes to the next steps, you have an offer in place. Usually you've got conditions tied to that offer. So the work goes into making sure we fulfill those conditions within the timeline we've set out in that period. So typically when it comes to timelines with home inspections, with financing conditions, it's usually about 5 business days. Of course, with the financing, we want to discuss with your mortgage broker. Some situations may require a bit longer. Sometimes things can get done sooner. So we want to understand that. And that's why having a good relationship with the mortgage broker, both from the buyer's perspective, but as well as from the realtor's perspective, just to have that dialogue going on the whole time, we can make sure we're lining up the timing so that there's not going to be any issues where we may have to request an extension for the condition. We want to make sure that we're getting it right the first time and fulfilling those conditions within the timeline we've set out. So when it comes to home inspections, your realtor is able to provide you with names of individuals that we've worked with in the past who are very experienced, that know what they're doing, and we bring them in and set a time. And usually that process takes about 3 to 4 hours, depending on the size of the home. And the cost you can expect usually runs around $300 to $400, again, depending on the size of the home that you're potentially purchasing. So just want to be aware of that in terms of an extra cost that will come up. When it comes to condos, it depends on the buyer. Some buyers want an inspection, which is understandable because there are still elements of the home that you want to be aware of, and want to make sure everything is in working order. Some buyers, if they're more handy or just more comfortable with condos, they may feel that's not a necessity. So it's a discussion that we have, and make sure that you're comfortable with either putting that condition in or not, depending on the home that you're purchasing. The appraisal process is obviously a big one and goes back to the financing, and is part of that financing condition. We want to make sure, so even though you're pre-approved for a certain amount, that doesn't guarantee that you're going to get that amount. So let's say, for example, you've been pre-approved for $1 million, and you've made an offer for $1 million for the home, but the home's value is only, let's say, $900,000. The bank is not, or the lender is not going to give you $1 million just because that's what you've been pre-approved for. It has to match up with the home's value, and that's where the appraisal comes in. And I think, Jacob, I don't know if you want to speak to this a bit, but that usually is the thing that takes the most time when it comes to finalizing the financing aspect of the condition.
Yeah, for sure. Appraisals are a funny thing because sometimes lenders don't request them. And a lot of times when you're putting less than 20% down, lenders do not request them either. It's not guaranteed, but the vast majority of the time when the mortgage is insured, when you're putting less than 20% down, the lender and the insurer will not request an appraisal because the insurer does their own calculations on the background. The majority of the time, they're happy with the value unless the property is outside of the GTA and you're offering quite over what market value might be. The important conversation that we have beforehand is there a chance that this property will not appraise for what we need to appraise it for? And in a situation where it is a seller's market and there are multiple bids and bidding wars, and you're, maybe going over what the potential market value would be, an appraisal is going to show the previous comparable. So it's not, what could this property be worth in 6 months, but it's what's been sold in the last 30, 60, 90 days that we can compare this property to. So in a market where prices are increasing quickly, you may not get the value that you need. In that case, we have to look at two different options. The first option is to make sure that we can back out of the deal within the financing condition period, if that's what you choose to do. Or the second option is to make sure we have a backup plan, which is in most cases is extra down payment. So can you put in extra cash to cover the difference? Can you get a bigger gift from your family to cover the difference? And if you don't have that backup plan B ready to go, then we need to make sure that we get the appraisal done within the conditional period. And we can order rush appraisals, which can be done in 1 or 2 business days. They are a little bit more expensive, like it's an extra $100 or $200 on top of the initial $300 to $400 for the appraisal. But if it's going to put you in a situation where you now know that the property is appraised within that financing condition period, and then you can make an informed decision about whether you're going to back out or whether you can increase your down payment should that appraisal come in low. That's a much more advantageous position to be in than just guessing and not being sure and then letting that financing condition period roll over, and then you could be in a much worse spot. So to answer your question in short, we can order an appraisal rush and get it done in 1 to 2 business days to make sure that at least we have that in hand and be in a much more educated position from which to move forward.
Great. Thanks. Yeah. So I'd say, those 5 business days are really crucial. And so you want to be making sure with your lender that they're comfortable with the timeline that's been set out in the agreement of purchase and sale. When it comes to status certificate, that's for condos. So any condo property comes with what's called a status certificate, and then it's a pretty lengthy document, probably 300 to 400 pages, depending on the condo. But it goes through the financials, the rules, the declaration of the condo corporation, a lot of different things that you will likely want to know about, but this is where your lawyer will come in and review that status certificate. You want to work with a real estate lawyer that is familiar with these and can highlight the pros of the building as well as the cons. They take a look at the maintenance fees and what's projected in the budget for maybe potential increases, or if there's going to be what's called special assessments, which are added costs on top of the monthly maintenance fees that owners of that condo may have to pay if there's large expenses that haven't been accounted for within the condo corporation's budget. So for example, if the elevator suddenly breaks down and there's not enough money in the condo corporation to pay for that, the condo will then go back to the owners and ask for additional money to pay for that sort of cost. So you want to be aware that, and you want to be comfortable that the condo is managing its financials appropriately, that there's not going to be any surprises. And that's what the status certificate does. So that's a really important document that we want to get reviewed. Typically, the seller will order it on your behalf. That's how we structure the condition for buyers. And if the status certificate is already ordered and is available, then your lawyer will typically have about 2 to 3 business days to review it, which is plenty of time for most lawyers to review. If it hasn't been ordered, it usually takes 5 to 10 business days from the condo corporation to come in. So that's a bit of a lengthier period to wait, but it's all covered within the conditions. So that can sometimes take a little bit longer. When it comes to the sale of your house, I know this is a first-time homebuyer seminar, so that likely does not apply to you. But even in this market, a condition on the sale of somebody's house is not very common. It's a very big risk for a seller to take on, again, especially in this market where things are a little bit slower. So you don't typically see that, but that is an option and something that can be discussed. When it comes to, since we are talking first-time home buyers, most of you will likely be renting currently, or maybe renting. So you want to think about the timeline to give the notice to your landlord about leaving your rental property, and it's required that you give them 60 days notice. So you want to factor that into your decision on closing date, and that's a discussion you can have with your agent to make sure that those kinds of timelines line up as well, so that you're not paying more in rent. You want to make sure it's kind of tight timeline there so that it all works out for you financially. I'll pass off to Daniel for closing day.
All right, we're closing. Okay, presentation's over. We closed. No, it's closing day. This is what you're waiting for. A few things though that you need to be aware of when this happens, because it's not as simple as you wake up that morning and you're a homeowner, although you're very, very close. Before we get to closing day, we mention here the final walkthrough. And so typically, as part of your purchase, you'll have the ability to have a couple of visits of the property prior to moving in. And we recommend you book the last of those visits to be in the week or the days that lead up to your closing day. And the reason for that is it gives you a final opportunity to double check everything. You want to make sure the home is in the condition that you agreed upon. It's in the condition it was in when you viewed it. And in a lot of cases, it's in the condition that you've laid out in the contract itself. It needs to be in. So things like the appliances need to be working, the lights, the plumbing, run the taps, flush the toilets, check for leaks, check the HVAC, things like that. And look for any unexpected damage that you didn't see before, or that is new that maybe you didn't notice, that wouldn't be permissible in the deal that you had. That doesn't mean any damage to the home needs to be fixed. It might very well be something that you would have been aware of or that wasn't covered in the agreement itself. But you're there to make sure that the home is in the condition that the contract laid out that it's supposed to be in. Also, there might be items that should have been left behind or taken away that you want to make sure have been so. Again, you're doing this ideally with a couple days or a few days ahead of time. So if there's things that need to be addressed, you want that to be addressed ahead of closing, because it's a lot easier to deal with it that way versus dealing with something that you inherit after closing has happened already. Because at that point, it's still possible, there's still an obligation to fix things for you, but you can imagine that once the money has changed hands, it's a little bit more difficult to chase after things that you're entitled to as a new homeowner. As far as the keys themselves, when the lawyer confirms that the funds have transferred and the deed is registered, you're officially a homeowner, and that can happen at any time on closing day. That's something that some people don't necessarily realize. So, a pro tip is when you're planning your move, if you have movers ready to be at the front door of your new home at 9 a.m., there's a not necessarily a strong likelihood, but there's a likelihood that you won't yet have the keys and that you won't have closed yet. And if that hasn't happened, you don't yet legally have the ability to enter that home. So we ran into this with a home that we purchased. We had a moving truck waiting outside our new home for hours because we weren't allowed in yet. So plan your move in for later in the day or even the next day if you can. Delays can happen. You don't want a moving truck sitting on the driveway. And until such time that closing does happen, which could be right at the end of the business day, or again, in some cases, delays can happen. They're not common, but if things happen, you need to be prepared for any and all permutations of what might happen. But once that's all happening, literally the keys are yours, the home is yours, you're a homeowner. We all pop bottles, we all give each other high fives, and the end of your fairy tale or the beginning, depending. You get to move to the next chapter.
Sounds really dark. The end of your
Yeah,
fairy tale.
yeah, no, not the end of your fairy tale. It's the end of
The
that particular
beginning.
chapter. It's the end of the prologue. But in any case, we do have time, and we're have. Oh, you know what? Forget time for
Yeah.
questions. We're not going to forget it, but we do want to. There's some important information that we do have here that I think it's cool that we've got some time for Jacob to go through. So I'll pass it over to him.
Yeah, awesome. I'll just touch on it really quickly. I get the question a lot, and I'm sure Katie and Daniel, you do as well. Is now a good time to buy? And I'm a firm believer that it's only a good time to buy if you are ready financially, emotionally, and all of that, because that's really when it is the right time to buy. But if you look at the market in general, and you're trying to time the market or get a good deal, it's very, very difficult to do that. What this chart is showing you is the relation between interest rates and house price change. So in all rate cycles that we've seen before, and a rate cycle mean rates coming up and then rates coming back down, we are currently on hopefully the latter half of a rate cycle currently where rates are on their way back down. Basically, in every rate cycle, home prices are inversely correlated, which means that when rates come up, average price change decreases, which means that homes either decrease in value or increase in value slower than they were before, because increased rates inevitably eats into people's ability to borrow or people's discretionary spending or people's desire to buy more properties. So what this chart is basically showing that the black line, when rates come down, house prices go up, and vice versa. When rates come back up, house prices go back down. You can see the black line that's coming up quite high on the far right of the chart is the peak of the rate cycle that we currently saw, where rates peaked in late 2023, and we started seeing them come back down mid 2024. What is likely going to happen to home prices is they're going to start to increase potentially exponentially as we see rates continue to come back down. We've seen 6 consecutive rate cuts by the Bank of Canada for a total of 2% in cuts, and we are likely going to see a few more rate cuts, 1 to 3 more cuts before the end of the year. Of course, just depending on what happens with the impending tariff situation. But as rates come back down, house prices go back up, and that's historically always been true. So if you are looking to purchase a property, sooner is probably better than later if you don't want to pay more for that property. And it's not a salesy thing. I'm not trying to say buy now, buy now. It's just this is what the data shows, and this is what's happened historically. So that's why I think this slide is important.
No, it's great. It's a great representation. Thank you. So we're going to open it up to questions. We do have some QR codes here at the bottom. If you want to just scan them to book initial consultation with Jacob, that would be your first step. The one on our side is just an email you can send to us just to have a call with us as well. So you can save those, and we'll send them out as well with the recording. But we want to open up the floor to questions. We did receive some ahead of time, but I'll just see if anybody else either in the chat or wants to come off mute if they have any questions right now. Just taking a look, waiting for somebody to come off mute potentially.
Or the
Okay.
chat, yeah. If you
Or
don't
the
want to
chat,
come
yeah.
off mute.
Yeah. Maybe I can jump in with one to warm things up maybe. So we did receive one or a few questions ahead of time, which were really great questions. So I can ask one of those. So Jacob, how would land transfer tax work if somebody's partner is not a first-time home buyer? They are.
Yeah, that's a great question. So it really depends on the status of your relationship, and not trying to be nosy. And if it's complicated, that's totally cool.
Mm,
But it basically, if you are married, legally married, then the person who's not a first-time buyer does not qualify for the land transfer tax rebate. If you're not married, you're considered a spouse under the Family Law Act if you have cohabitated for a period of 3 years or longer prior to purchasing this property. So it gets a little granular if you're not married. If you're two people, say, one is living in a condo that they own and one is living at home with their parents, and then they are purchasing a property to live in together, but they're not married, one owns a property, the other one didn't live in that property with them, then technically that other person can still qualify for the land transfer tax rebate. So it gets a little more granular if you're not married. At the end of the day, I say talk to your lawyer because they're the ones that make the ultimate decision on that. So in any matters of do I qualify for this or that, according under what law, act, etc., always talk to your lawyer.
thank you. I can ask a couple more, but anybody that wants to jump in can feel free to do so. We'll keep the chat monitored. Another question is, can the cost of, let's say, some renovations or construction, if somebody wanted to do that to the house, be added to the mortgage?
Yeah, another great question. So there's a couple ways to go about it. There's a program called Purchase Plus Improvements, and basically what that means is we would get the mortgage approved based on the increased value of the property according to whatever renovations are going to be done, and then part of the mortgage is held back and then reimbursed once the upgrades are finished. So the way you would go about it is get the mortgage approved for the higher value of the property. You then go and do those renovations. You have to pay for them out of pocket. And then once the renovations are done, the lender will send an inspector to make sure that the renovations were done up to code and up to the way that we presented it to the lender initially. And then they will basically reimburse you for the costs of those renovations. And that is the increased mortgage amount. It is a intensive process. It requires getting quotes up front, paying for it out of pocket, getting the inspection done. So it's not that it's a bad program. It's just there's a lot involved. The other good way to do it is to if you have a larger down payment, you can get a mortgage and get a home equity line of credit on top of it, and then you can pay for the renovations with the home equity line of credit, and potentially even then lock in that home equity line of credit into the mortgage and make it a fixed term portion. So the interest costs on that what you use to pay for the renovations are slightly lower. So there's a couple ways that we can go about it, and it really just depends on your financial situation, how much down payment you have, and the scope of the renovations as well.
Mhm. Okay, great. And in terms of pulling equity out of your property, how do you go about doing that? And would there be any, like, I guess, rules in place for that option?
Yeah, so if you currently own a property and you're looking to purchase a second one, or you just own a property and you're looking to pull equity out, there are a couple ways to do that as well. A home equity line of credit can usually be offered by your existing lender, and that's usually the easiest way to do it. You can go and talk directly to your existing lender and get a home equity line of credit put on the property, and that's basically a revolving credit facility, just like a personal line of credit or credit card. You can have a balance of, or sorry, a limit of 50,000, 100,000, whatever it is. If you don't use it, you don't pay for it, but you can withdraw from it as you want to and pay it down as you want to as well. It's great to have for renovations. It's great to have for an emergency fund, quick access to a large amount of money if you need it. But again, if you don't use it, you never have to pay for it. And then the other way would be refinancing the mortgage. So you could break your current mortgage and apply for a bigger mortgage, or you could go to your existing lender and they may negotiate refinancing your mortgage before the end of the term and maybe not charging you a penalty or something because you're staying with that existing lender. These days, with the way the competition is in the market, the lenders are willing to make concessions on things like penalties in order to retain you as a client, just because retention is the name of the game for lenders right now. So if you are looking to pull out equity out of your property, talk to your mortgage broker or talk to your existing lender and just see what your options are.
Great. All right. Any other questions from anybody that's currently logged in? I'm not seeing any. So please just take a quick camera shot of these QR codes so that you can reach out to us and set up a time to talk a little bit further. Everybody's situation is different, so we want to make sure that we are available to answer your specific questions, because I know it all depends on a lot of different factors, especially from the financing side. So that's what Jacob's here for, and we're always happy to discuss anything. Is there anything else, Daniel, Jacob, you wanted to say?
I'll just add, I mean, it's cliche, but there's really no stupid questions. I think a lot of people get nervous that they should know things or you know, common sense or whatever. Or they're just embarrassed to ask questions that seem like common sense. There is no common sense. I mean, even for people who are seasoned veterans, every transaction is completely different, right? We've done lots and lots of different deals. We've seen lots and lots of different deals, and no two are the same because everybody's situation is different. And with that come questions that are all good ones, right? And on at the end of the day, like knowledge is power for you. And when Jacob talks about things like, you know, banks are competing for your business, you are someone that, you know, people want to work with, and you need to equip yourself with the knowledge of the process so that you're better equipped to deal with them, right? And align yourself with people who are working in your best interest, and those are the people who are there who will listen to your questions and take the time to make sure you're comfortable with the process. Because it's been said a lot of different ways in this presentation over just an hour. You need to be comfortable and you need to feel good about what you're doing. It is a great process. Buying a home is literally, it's the dream, right? But you don't want it to be a nightmare because you don't know what you're doing. So make sure that you are comfortable, and just that only comes from asking as many questions as possible. So definitely reach out to either of us or your agent, um, and just equip yourself with the knowledge and have fun with it.
Great. Okay, well, we'll send out the recording to everybody that signed up. Thank you so much, everyone, for coming. Thanks, Jacob. Thanks, Daniel. And yeah, have a great day. Stay warm, stay safe.
Keep fit
Thanks.
and have
Thanks,
fun.
everybody.
Okay, have a good night.